And this process is underway. The public sector banks have risen to the occasion and have done more than what was expected of them. And my belief is when this process is taken to its logical conclusion, they will have sustainable balance sheets to support the growth that this country very much needs, the extra growth that it needs. Now, what this cleanup process has also entailed is really a change in the culture surrounding the loan contract in India. And I want to talk a little bit about that because some of the structures that we in the Reserve Bank have brought in have also been to change this culture associated with credit. I will also in the process address the issues about declaration of NPAs and so on, especially vis-a-vis small and medium sector. So to start with, let me go to evidence. My friend Surjit Bhalla in Delhi has a column which is entitled "No Proof Required." And I think it's a tongue-in-cheek statement about the fact that so much of debate in India takes place without any evidence. And as a result, anybody can say anything and get away with it. So what I want to do is show you some slides. And I want you to conclude from this. This is not regressions. This is not complicated economics. This is just some slides. And I want you to take away what the logical conclusion from all this is. Okay, so let's start. Slide 1 is non-food credit growth. Okay, this is credit growth, but it's broken up into two groups. One is the private sector banks, the new private sector banks, the biggest Axis, HDFC, ICICI, and IndusInd. We've left out Kotak because it did a merger during this period. So that's the light yellow line. And what we've plotted here is credit growth. So what you can see is non-food credit growth is hitting 25% a year for the private sector banks. That's fantastic. That's about as strong as it ever gets. Look at what's happening to the public sector banks. It's shrinking. It's below 10%. Okay? And that's something to worry about because the public sector banks are the biggest banks in our economy, accounting for about 70% of the assets of the banking system. Now, you may argue this is because the sectors the public sector banks in. Well, let's look at the sectors. If you look at credit to industry, industry is suffering. People say there's no credit demand in industry. Look at what's happening to private sector banks. Once again, credit that they're giving is north of 20%. Credit growth is hitting 20% per year by the private sector banks. What's happening to the public sector banks is going negative. Now, that's an aberration because Uday bonds have been taken out of the credit column for them and put in the investment column. But nevertheless, credit growth was falling. The rate of credit growth was falling and was below 10%, below 5% for them to industry. So industry is not getting credit, not from everybody, but from the public sector banks. Look at agriculture. Private sector banks and public sector banks were going neck to neck in early 2014. By the way, all these numbers start in early 2014, April 2014, and go on to the current period. Okay, so let's go back to agriculture. And what you see in agriculture is they start about the same in April 2014, and again they diverge. Private sector banks are lending more credit, have more credit growth to agriculture than public sector banks. In a period of drought, when you think the public sector banks would be going out and lending, the private sector banks are lending at a faster pace. Now, there may be different bases. Private sector banks may start out with a smaller fraction of lending to agriculture. That's not necessarily borne out by this graph, but nevertheless, this is an issue of interest. You mentioned small and medium enterprises. Public sector bank growth to small and medium enterprise, 0. That credit growth to small and medium enterprise from public sector banks is 0. Private sector banks, again, north of 25%. Okay? And again, this starts not now, but from 2014. Steady decline from early 2014. Okay? Personal loans, here the picture is different. Public sector bank credit growth to personal loans is picking up over this period. These are loans to individuals, retail loans, and so on. and reaching closer to where the private banks were. Private banks were always strong in personal lending. Public sector banks are getting closer. And housing loans, there's no difference now. Public sector banks are growing their housing loan portfolio at the same pace as the private sector banks. Okay, so what is the point of all these charts? I think the point is to take away what the implications are. First, it's not that the entire banking system has stopped lending. Now, if the entire banking system stopped lending, you could either say that it's because low demand, and you could blame things like monetary policy. Interest rates are too high, nobody's borrowing, there's no investment, no credit growth. This is because of the RBI, set interest rates too high. But if the private sector banks are lending, typically private sector banks charge somewhat higher interest rates than public sector banks. Private sector banks are lending and there's strong demand for their lending, so much that their growth is 20-25% in each of the areas. That says it's not monetary policy. How can the private sector banks be lending so strongly to the small and medium enterprises while the public sector banks are not lending? Now you may say it's something to do with the public sector banks. Maybe they don't have enough capital. But then why are they increasing their lending to retail loans and housing loans? I think the conclusion you have to come to from looking at this evidence is that the real problem is they have a lot of exposure to distressed sectors in the economy, and they are trying to reduce the exposure, clean up the exposure, especially to things like infrastructure, to steel and so on. And private sector banks in the meantime are much healthier, have lower exposure, and are able to increase their exposure sometimes in those very sectors. So the answer to how we move ahead has to be that we have to increase the pace of cleanup. Now, one of the things you could argue is that it's the cleanup itself which is the problem. The cleanup, the asset quality review is forcing the public sector banks to shrink lending. But if you look at the chart, take a look at this chart, for example. The slowdown in public sector bank lending has been steady right from April 2014. The RBI stopped forbearance in April 2015, and the asset quality review started in end 2015. Unless the public sector banks had perfect foresight and could see the future, it's hard to argue that was responsible for the slowdown in lending. So once again, the conclusion is that a growing distressed portfolio in certain sectors made the public sector banks either more risk averse or less willing to take additional exposures in those sectors because there's such a big part of the banking system. As a result, lending growth in those sectors fell considerably, and stress in those sectors increased some more. Okay. So let me then move on from this to talk about what the sources of stress might be, and let me go back to the front. Let me go back to what the sources of stress might be and talk a little more about how we've been trying to help the banks deal with them. So there are two sources of a loan turning bad on a bank balance sheet. One is the fundamentals of the borrower are not good. The borrower cannot generate cash flows and as a result cannot pay. That's one source of stress.